we can't afford it, they can't afford it. So when you look at kind of the cost structure model, our advice point is coming in. You got to look at what we're going to be doing on the technology side and double that for marketing sales. So I'm going to do Title III as an option. I think that Title III is going to come online at some point. I do. I'm still a believer. I do think that it will not come online and be as expected and promised when originally promoted, and for a variety of reasons. One of the reasons is that the folks in the room and that have the portals that we've all talked about, all of you are survivors who have not built systems waiting for the promised land of crowdfunding, but have built and operated within the existing regulatory environment and are building customers and building investors and building transactions. And the fact that there is so much momentum in that existing market, and those folks are so well established in brand and brand recognition, means that they're going to largely define how the Title III space ends up emerging. So Title III will be far more of an option integrated into portals that are doing the other exemptions as well. That, and with all great respect to Sunny, who's not here, I actually think that at the end of the day, the SEC will publish Reg A Plus long before they publish Title III. Reg A Plus provides much of the promise of crowdfunding, and I think that it's going to be far more attractive because it comes out earlier and people gain traction with it and they'll get to know it and use it, especially in the high volume areas of things like real estate. That Reg A Plus will supplant in the marketplace the promise of Title III. So where will then the Title III energy go? I'll tell you, it's going into the intrastate exemptions. So we didn't talk about that much in the legal panel yesterday, but there is, one of the lawyers correct me, there's 6 states now that have passed expanded intrastate exemptions. There's 12 additional states that have them in front of the legislature. I'll tell you, I believe within 3 years there will be a crowdfunding intrastate exemption in all 50 states. Many states already have it, like California had a direct public offering exemption. They're just updating it and improving it. So we're going to have, like the pre-Reg D time, we're going to have a patchwork of exemptions all over the country. And we have multiple sites in the development track at Community Leader who are specifically designing unique portal communities, like portals, subportals, or affiliated and associated portals working with each other who are specifically targeting intrastate exemptions. So like Wisconsin, I've got a Cheddarhead site focusing on, I'm just kidding, that's not really what they're calling themselves, but that's our internal name for them. So the Cheddarhead site that's specifically focusing on Wisconsin exemption. Why I think that works is that when you look at what the Title III, when they put the restrictions on it, was going to work best for, it was the small, local, community-based endeavors that were going to have largely a limited geographic appeal anyways. So those will be great. What they're going to miss, the interstate will miss, is the tail, the long marketing tail communities that are not geographic. So for example, one of my favorite sites that we are working on is called the Horror Equity Fund. It's focused on the horror industry. The H-O-R-R-O-R industry. You know, undead funding. Bring your project to life. Vincent Price's, they've got the license to all of Vincent Price's voice. So when you go to their site, you'll get Vincent Price's ha 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 ha, whatever. But those are interesting portals because they're niche communities that cross geography, but they're also small, relatively small projects. So they're going to need a Title III-like, and I think that they're going to end up finding themselves doing those almost all as Reg A plus. So my expectation, looking at our legal interaction with customers that are coming in is Title III will come online. I don't think that Patrick Henry's bill for redoing it and reopening it has any chance, and if they do push it really hard, it'll end up being supplanted by SEC-driven language as it goes through the Senate. So I actually think it's a fairly poor strategic move. But I think that the energy and the dream of Title III will show up and live on in Reg A Plus and in the intrastate offerings until about 5 years from now, when the marketplace can't tolerate 50 different exemptions and there's a new roll-up and we create a Reg E that will do like Reg D and do a roll-up of all the interstates in a new model. Follow-up question?
Yeah, follow-up. Is the objection mainly because it's only limited to 1 million every 12 months? I mean, I know there's also compliance costs, but if you look at it from an issuer's perspective, you probably wouldn't do Title III if you're going to raise only 30 grand, because maybe it'll cost you 20 to even bring your company to a portal, right? But if you're a small company like a restaurant that maybe needs $500,000 to open a second restaurant, from an issuer's perspective, will Title III work for them, or is everyone against Title III because it might not work from a portal perspective? I'm just trying to get
Yeah. So is the objections to a Title III more driven by it won't work for issuers, or is it more driven by there isn't a business model for portals? Or is it driven by the politics of the relationship between FINRA and the SEC? Or is it, and the answer is yeah, all of that. The actual cost of capital, what folks forgot, or seemed to forget, was that even in Title III, it's still the solicitation and sale of a security. You're still going to have a private placement offering. You still got to have your legal framework of your business structured and put together. You still have to have bad actor checks on the board. And you still have to do all these things. It's not like it's exempt from having your business properly prepared to go into a private placement offering. And those are all still expenses. And we may drive down expenses with innovative automations for creations of base templated PPMs, and we may drive down the cost of verifying the bad actor check to $20, $30, but you got 5 people on your board and boom, 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 these costs are going to add up. It's still going to be $5,000 to $15,000 to do those, and the company that wanted to raise 50, that's a cost of capital, especially when there's no guarantee on the other side, they will never do. And there isn't a revenue model for the portal, so even if they create a licensing process within FINRA that fulfills on the SEC promise that portals will be able to create transactional revenue, still with the caveat that they're going to have to go through FINRA in some kind of licensing plan, there's still going to be such a small percentage there that the volume would have to be so high to make it work that the portals, those of us that are putting together portals, know you're not going to be able to sustain a business on Title III alone anyways. And your chance, you're going to do Title III as a loss leader to pull folks up into another one as you build an established relationship with them. So I would say it's all of those, plus it's looking at what's going on in the relationship between FINRA and the SEC as it relates to rolling these rules up. Okay.
Can I just add to that?
Yeah, please do.
I have seen, and you probably are familiar with, somebody did a analysis, a spreadsheet of the cost of Title II compliance from both portal and the issuer perspective. And it runs through, how much the estimated cost of compliance, and it's not just up front, but it's over a 5-year period afterward, because there are ongoing reporting. So you might be able to, you guys might have done one, or you might be able to direct him to a place that actually walks through those numbers.
So this kind of comes to the business model too, because that's where walking through those numbers are so critical, right? Because the business model for the portal has to look at what the actual cost of capital is going to be for the issuer as well, even if it's an individual issuer. So we have a book on our site that you can download. It's at learn.communityleader.com. Scroll down, it's a book called Navigating Your Portal Launch. It's a free download. It's 40 pages of pontification from me, but it also includes a lot of quotes from a lot of our clients at that time it was written, and it goes through a lot of those issues. Our clients that do a Navigating Your Portal Launch workshop actually leave with a spreadsheet of all of those different metrics so that they can figure out what the right way to position is. And maybe that's something we can do in a future show, is that we could bring some accountants and people that are operating portals and show actually what that cost of capital would be in these different exemptions for a $1 million raise, a $5 million, $10 million raise. Also have to look at, especially in real estate, while the $1 million was great, and we all know that in certain markets, like in New York, $1 million, woohoo, there it all goes. You know, so there's some issues there. So coming back, I think the Title III energy will live on in intrastate and Reg A plus raising. Holy cow, are you serious? Man, I wasted time. All right, I'm gonna go really fast. What was this one, qualified? What was that about? Anybody remember?
The role of qualified funds.
Okay, so for unaccredited investors especially, but for all mid-level wealth investors, the self-directed IRAs, qualified funds, are going to become a very appealing source. And I think that as we project further out, as the regulators look at how to manage that money properly, the role custodians play will be critical. And I think that it's really great for the industry that we see so many self-directed IRA providers in the room. That being said, I think it is worth those of us who care about this industry a lot to take under a cautionary note what has happened for the self-directed industry, right? When the law changed to allow for self-directed IRAs, and for those of you that don't know, real quick, you have checkbook control over your IRA. You can write, you have checkbook control. You can invest in what you want. Largely, there's some exceptions of things, not a family member, not something you're going to benefit from. You can't buy a racehorse with your retirement funds. But regardless, very, very important way. And in the law, the title itself, they say, hey, look, in retirement funds, there's X trillion in Wall Street. We just pull 10% of that out to invest in Main Street. That's the financing for the revolution right there. But let's look at when they changed those rules, there was a flood of activity. There was a flood of businesses. Everybody was starting a self-directed line and self-directed IRA funds. And they talked about it was going to be a $1 trillion industry. Sound familiar? It's the same rhetoric as now. It's about democratization of financial services, empowering individuals to take control. It was great, right? And now you take the total number of accounts of the top 5 custodial providers in the United States, it's maybe 300,000 accounts. What happened? What happened was that $1 trillion industry was coming from somewhere. It wasn't new money. It was coming from established players. And guess what? They didn't roll over and just watch the money disappear. They set up barriers to it happening. They went into the regulatory markets and created barriers. And then they did even this best thing, which is they created at Merrill Lynch or First Bank or US Bank things they called self-directed funds, which weren't. But you got to pick from 3 or 4 options, so you felt like you were getting one. And it took all that energy out of the innovative asset, new emerging model, and pushed it right back into the people who always won the game. So I think there's already trends where the institutional investors and players are looking at this industry and going, we'll be able to do the same thing. You'll be able to log into your Merrill Lynch account and crowdfund. And they'll have cute little boards, and there'll be all of their pre-approved funds that they've brought in. And so we have to acknowledge, look, and watch for that, and that trend. On a lot of the peer-to-peer lending sites, we can get into this. Now it's time, just let's go for a little bit. On a lot of the peer-to-peer lending sites right now, they have institutional investor APIs, where institutional investors like at Prosper are paying the Prosper server 5 times a second, pulling every new deal off of it, running it through their algorithms to make a buying decision, and within 10 seconds of that deal being posted on Prosper, they're making a decision about whether or not to buy it. The rest of us, when we go to Prosper, are getting all the deals that the institutional investors decided weren't worth their time. So if the average rates are 12% or 6% or whatever they're saying it is now, you can be very sure the institutional ones are a lot more than that, and the regular retail people showing up at Prosper are a lot less. So that's where the institutional players are already moving in and destroying the big vision of this space, and we have to be cognizant of that if we care about this. So if we look at then the consolidation of the qualified fund space, you went from literally 30, 50 self-directed custodians to really now there's about 5. There's a lot of retail providers, but behind the scenes, there's not that many. So consolidation happened. And the consolidation value points was how many accounts you have, how many accounts you were managing, and that determined the value, for all extent and purpose, the value of that. So in the consolidation of this sector, that's, a lot of folks, it's going to happen, and it's going to be great, and guess what? We're still on the expansion. There's going to be more and more portals, more and more opportunities, and then it's going to contract, and a couple will emerge, and then it'll expand again, and that's just kind of how it'll go. The value will be based on 3 primary variables, and the consolidation will be driven on those variables. Number 1 is going to be a pipeline and ability to cultivate, maintain a qualified, curated pipeline of deals on an ongoing basis. So for example, Lending Club, their ability to continue to bring quality product to market will be of value. This always comes down to who's the customer, who's paying the bills, the people who truly have investors. And one of our partners comes out of the print industry, and in the print industry, we see on a regular basis that reporting requirement of how many of the magazines have been distributed, how many went to subscribers, you're going to see metrics like that for sites. How many investors have really signed on? And you're going to have PricewaterhouseCoopers and other folks like that who actually do audits and will be able to communicate what is the real investor volume on these different sites.